In his video, How the Economic Machine Works, Ray Dalio does a great job of explaining how our current economic system works. But he also reveals its greatest flaw, and that is central banks. So in this video, we're going to analyze Ray Dalio's video to find out how central banks create the boom and bust cycle. In short, Ray Dalio explains 3 economic trends that basically comprise the development of the economy. And those are, number 1, productivity growth, which is just there because people collectively gain knowledge all the time, technology improves, so the economy naturally grows at a consistent rate. That's the basic rate that our economy grows from. Then he mentions 2 other trends, and those are the debt cycles. And those occur because people take up debt to spend now, but they have to pay that back in the future, and this causes cycles. And those happen in 2 frequencies, a fast frequency of 5 to 8 years and a longer frequency of 75 to 100 years. So all these 3 trends put together comprise a picture where the economy goes up and down until it eventually intersects at some point again. And this is important to point out because at some point they intersect. That means even without all the debt cycles, at some point we will be, according to this model, at the exact same place that we would have been if there had been no debt cycles. So if we end up in the same place, why do we have to go through all these debt cycles? Well, to understand this, we have to, as Ray Dalio, look at 2 things. Number 1, the interest rates, and number 2, spending. So if we watch Ray Dalio's video, he says that when an economy overheats in a boom and there's rampant inflation, the central bank has to raise interest rates in order to cool off the economy. Well, what does this mean? If the central bank can raise interest rates to cool off the economy, that inevitably means that before interest rates have been too low and allowed the economy to overheat. So the end result is that the central banks consistently keep interest rates either too low or too high for these cycles to happen. So how is it that the central bank can even do this? The central bank can create money. So they can lend money at any rate they want. It doesn't matter. They can create it out of thin air. So what would happen if there were no central bank? People in the economy would have to rely, if they wanted to borrow, they would have to rely on savers, meaning other people that provide the capital to the banks, which can then lend it out to businesses and people. And those banks cannot go to the central bank, they have to rely on the savers. And how are interest rate determined then? Well, like with every price, when there's a big supply of capital and low demand, the price goes down. In this case, the price of capital, which is the interest rate. On the other hand, if there is a lot of demand for capital but no supply, prices go up. In that case, the interest rate goes up. How does it actually work? Well, the banks act as an intermediary between the savers and the borrowers. And if all of a sudden there's a lot of people who want to borrow and nobody wants to save, say for example, a new incredible Apple device comes out and everybody wants to have it. People liquidate their savings in order to buy it, and others want to borrow in order to buy it as well. Well, the banks who are in the middle and who can provide loans know that the capital that is available is not enough to satisfy even just a fraction of all the demand for loans that is out there. So what they do naturally is they increase interest rates. So only those who really want to buy this will get the loans to buy it. On the other hand, it doesn't just increase the interest rate for the borrowers, it also increases the interest rate for the savers. What this means for the savers is that if they bring their money to the bank now, they will get a big return for it, and maybe they will rethink if they really want to spend their money or give it to the banks. And this would replenish the savings of the economy. This is the natural way with which savings would be reallocated in the economy, where the banks cannot just go to the central bank and get that money. And what the natural effect of it is that interest rates will always automatically and consistently readjust to what the supply and demand in the economy is. And those erratic artificial swings caused by the central bank wouldn't be possible. What the central banks in our current system allow, on the other hand, is that Everybody is able to borrow while nobody has to save. And the result of that is what Ray Dalio explains, that we're basically borrowing from our future in order to spend in the present. And 5 to 8 years later, or even more, we will have to pay for this during a bust. So in essence, the difference is that whereas in a normal economy without a central bank, people in an economy borrow to each other, when there is a central bank, everybody can borrow at the expense of the future. This was how interest rates are partially responsible for the boom and bust cycles. The other important aspect is spending. And Ray Dalio also does a great job here in explaining how spending gets out of control and becomes unsustainable in our current economic system. What he says is that when a person has an income of 100,000, they're able to borrow an additional 10,000 and they spend that money. So they can spend 110,000 instead of 100,000. What this means, since their spending is another person's income, that person's income rises. And if this person has a higher income, he can borrow more and spend more. And the third person is going to have yet a higher income. And thus, this is going on, and spending increases with every one of these loops. But all of this can only happen in the current system that we have. Because let's look at the opposite. If there were no central bank that can supply this additional money for additional spending. If the person in the first loop would have to rely on savers instead of the central bank for their loan, that means there is someone who has to save for this person to borrow. So let's say the one person borrows 10,000, that means another person saves and therefore does not spend 10,000. So if you net it, you will get an increase of spending of 0. And the whole loop that Ray Dalio is explaining would be killed off after the first round. So this is how, if there were no central bank, these artificial booms would be impossible to develop. They're only possible if there's this additional central bank money that feeds the system all the time. So we've seen that the manipulated interest rates and also the unsustainable spending both are responsible. They're enabled by the central bank and they're responsible for the boom and bust cycle. So you could counter that banks can create credit without a central bank, and that would be true because banks can lend out more than they receive from savers due to something called fractional reserve banking. However, to the extent that it is happening today, where banks lend out up to 40, 50 times what they receive in savings, this can only happen as long as there's a central bank in the background that can bail out the banks when savers actually want their money back. So at the root of the problem remains the central bank. And in the long run, we would at least be in the same place that we are right now. But actually, we would be a lot better off. Because what happens during the booms, these artificial booms, is that a lot of resources are misallocated. And that is because business models that are unsustainable and unprofitable and that are in effect destroying wealth are being kept alive by cheap credit. These companies are called zombie companies. And a good example of this is possibly WeWork, which was able to, within a very short period of time, become the largest landlord in London. And it is questionable to this day if they ever had a really viable business model. They have probably just been kept alive by cheap financing and still are. And then during the busts, there is so much collateral damage that much more wealth is destroyed than otherwise would have to. So, for example, when the companies go bust, not only those bad zombie companies, they dry up the credit markets, there's a huge crisis, and even healthy companies suffer from this. But all of these are just economic factors where we would be better off if we didn't have central banks. But as Ray Dalio explains, when the long-term debt cycle turns from a boom into a bust, there is huge risks. There are risks of hyperinflation, of social upheaval, and even war. So what we're risking here is really the worst of worst situations every 75 to 100 years. So we can conclude that the primary culprit for the boom and bust cycle is the central banking system that makes sure that in the long run we're worse off economically than we otherwise would be. And because of it, every 75 to 100 years we have to face the threat of a total economic collapse, of social upheaval, and even war.